Hi, this is Kevin Gormley, and today I'm going to be talking about why Warren Buffett probably pays less of a tax percentage than you do, as well as I do. And so I'm Kevin Gormley. I'm a CPA that does financial planning. I do some tax work, but I would implore you that if you're interested in these strategies, to dig a little bit deeper. We're just going to be scratching the surface, and I wanted to make something that just gets the strategies across, as opposed to, diving into the tax law and putting everyone to sleep. So if you're a person who does tax, and you kind of hear the way I've expressed things, I'm happy to get some feedback on that, but I want to make this easy to understand. So let's talk about Warren Buffett. He every year there's an article that says he pays less of a tax percentage than his secretary. Now, he does pay a lot of tax dollars. He probably is among the top few people in the country with the amount of dollars they pay, but he does pay a much lower percentage. Last time it was looked at, it was between 17 and 18%. So the first concept, okay, we're going to do three things here. The first concept is this earned income versus unearned income. And that's kind of tax speak. So let's put it more in human speak. This is like how much money you get from your job, or if you're a partner in a firm, a law firm or something. This is the amount of money that you get paid. It comes either on a Form W-2 this time of year, or it comes on a 1099 if you're a contractor type person. If you're a partner, you get it on Form K-1. But this is just the money that flows to you from your job. And so there are some opportunities here to defer some of the money, but you really get on the real progressive income tax system when you earn your money. And so that's where you go from 10%, 15%, 18%, 25%, all the way up to 39.6%, plus some other bonus taxes. So that's the reason why I implore people to try to put as much money as you can in your 401k, simple SEPs, or other things, okay? So this is the money that flows to you from your job. This unearned income is basically when you have a pile of money and you can invest it. And so how do you get from here to here? Well, it goes slowly. If you're earning a good living and you need to live off your money, you're going to have to spend it. But whatever you can save, and here we're talking about a taxable account when I say that you have a pile of money, and this pile of money is taxed differently than money you earn from your job. So what Warren Buffett has is he has a pile of money, a big pile. And in the book Snowball, they talked about how the pile just gets bigger and bigger. He was always, I think, pretty wealthy. But anyway, so he has this big pile of money in the form of Berkshire Hathaway stock. And so because he knows tax law and he knows the system, by having all this money in Berkshire Hathaway stock, it doesn't pay a dividend. And guess what? All of these tax rates, or many of these tax rates with investments, are preferenced items. And preference is a fancy way of saying they have a better tax ladder than the ladder over here. So when Warren sells Berkshire Hathaway stock, he probably pays 20% on that capital gains. Now, you can go anywhere from 0% on capital gain ladder to 15% on the ladder to 20%. And so he's probably paying 20% when he sells Berkshire Hathaway. But the issue is all the money that's in Berkshire Hathaway and being invested, and that money can grow, that's called unrealized capital gains, not taxed. Good system. Own a company for a long period of time, it goes up in value, you don't have to pay any tax. So that's the first reason why, is that Warren is not being, as a matter of fact, his income, I think, with Berkshire Hathaway is maybe $100,000 a year. It's not high at all. The nature and the timing. Okay, so again, when you're in this category and you're getting paid, there's not much you can do about the nature and the timing. It comes to you every 2 weeks or every month. You pay your tax. As a matter of fact, you send it to the IRS every time you get a paycheck if you're a Form W-2 employee. When you're in the situation where you have investment money, you really can decide on how you want to play, and I don't want to call it a game because it's not really a game, but how you want to set up your financial affairs to pay less tax. And so if you put equities or stocks or stock funds into a taxable account, if you use certain types of partnerships like master limited partnerships, if you use rental real estate in a taxable account, you are setting up the system so you can decide a little bit more about the nature and sometimes the timing if it's with capital gains. And so that's what Warren Buffett does. He decides when to sell Berkshire Hathaway if he wants to sell Berkshire Hathaway. He also has a team of accountants. We all know that. But when you are an investor as opposed to a worker, you can control the nature and the timing, at least somewhat. The third thing is knowledge of accounting and tax. And by the way, I'm not advocating anyone go back to school or really get a deep dive study in accounting and tax. If you do and you're sick like me, I feel very sorry for you. But the thing that I realized when I read the book many years ago is that Buffett is actually a genius when it comes to accounting, when it comes to taxation. And I don't want to get political here. I know he's advocated now that wealthy people aren't paying his fair share. Well, it really appears to me, and this is a commentary on my part, an opinion, if you will, that Warren Buffett set up his financial life understanding these concepts, and now he's so wealthy that, yeah, it's easy to say, I wish I could pay more tax, and he can always send it in. But the one example I will give you about his knowledge is that early on he discovered, first of all, if you pay a lot of tax, you don't get to keep a lot of your money. But he discovered insurance companies, and some of the first companies that he worked with and bought, and when he established Berkshire Hathaway, are insurance companies. Now, why is that? Why are they so exciting to him? Well, you can get paid premiums. People take insurance. They send you their premiums every month, and you can kind of realize when you're going to have to pay out, about how much you're going to have to pay out every quarter. Now, they always say that an insurance company knows how many people are going to die, but they don't know who. But, there can be some catastrophic events, but pretty much when Warren gets those premiums, what does he do? He invests the money. What happens when he makes money? Well, he gets to keep money in reserve. And so he can build up a really nice reserve. And I'm not going to say that I'm an insurance accountant, but he can build up a reserve that he needs to pay out claims. And so Warren very early found that by keeping it in this whole system, it's like a tax deferral system. And so there's other things that he did in his investing career where, he used exchanges of property and all these other things. And I won't get into it because I'm going to put you to sleep now. But all I would say is having an understanding, even if it's just strategic, you don't have to get down to the tactics, but having an understanding of the tax law, having an understanding of the fact that you sometimes can look at the nature, at least the nature, and get tax preference items, and sometimes you can control the timing even when you realize taxable gains. And try to get more money either into the unearned income category or defer money. And then when you start taking your money out when you're in retirement, once again, this thing is very important, because if you have $5 million in an IRA and you need to take out a ton every year, guess what? You're back pretty much to the rules of getting whacked for every dollar you take out. So anyway, hopefully this was somewhat provoking, but I'm happy to speak with anybody about these strategies. And we do have a white paper that's available. It's about 25 pages, 30 something when you look at the appendix, which is called the Roadmap to Investing for the High Income Investor. And it's all about trying to help people that are making a lot of money get money from here into here and build enough money so they can be financially independent. So again, Kevin Gormley, Leading Edge Financial Planning, a CPA that does financial planning. Thanks so much for listening.